Good afternoon. Welcome to the SuperReturn Africa focused webinar. I believe it's the first one we're doing ahead of the SuperReturn Africa conference at the end of the year. My name is Oscar Silva. I've been advising private equity firms in emerging markets, and I'm currently focused in Africa, especially working with SME first-time private equity funds in both Western Africa and Eastern Africa. The topic of today's discussion is the rise of Africa's frontier markets. And with me, we have two panelists. First, we have Allyson Klein, who is the manager of FMO. I'm sure you're very familiar with FMO, which is the Dutch Development Finance Institution, with a committed equity portfolio of over 2 billion euros. And we also have Ibrahim Sanya, who is the head of financial advisory for Africa Finance Corporation, a Nigeria-based multilateral institution which is focused on infrastructure and with a capital base in excess of $3 billion. Obviously, it's quite wide, the area of topics that we can talk on Africa private equity opportunities. So today what we're going to do is we're going to focus a bit on how do we define frontier markets, first of all, and then we're going to start a lively discussion on issues focused on common investment themes across African frontier markets with particular emphasis on infrastructure. And we're also going to talk about how to support business platforms in Africa in key sectors. Last but not least, we will talk about supporting regional financial institutions as part of the private equity effort driven. The total presentation and discussion with the panel participants will take about 45 minutes. And then we'll have a final Q&A question for about 15 minutes. This is going to be on an anonymous basis, so feel free to basically type your questions, and we can address them with the participants during the discussion. Why don't we go ahead and start now with the first topic, which is how to define a frontier market in Africa. As you may be familiar, the term frontier market has developed over the last decades. Today doesn't mean what it meant 10 years ago. But I think there's a bit of consensus that developing country, a frontier market is a developing country, which is more developed than the least developing, but too small to be considered an emerging market. So it's sort of like the middle countries in the emerging markets spectrum. In the case of Africa, there are several stock indexes that define and characterize frontier markets. We're talking about primarily 11 countries which represent in Africa about 1/3 of the regional GDP and 1/3 of the population and about 20% of the landmass of Africa. These countries represent Africa very well in terms of geography and economically as well in terms of GDP size, range, and GDP per capita. Alison, if you would like to add a few points in terms of the methodology that we're going to use today on frontier markets, please go ahead.
Certainly, thank you, Oscar. I think maybe just for the audience, it's interesting to note that we did have a discussion before the panel and discussing how do we define a frontier market, and the definition you've given is I think one that we'll use for this conversation. But in fact, each investor may have a different understanding of what their frontier is. I think in Africa, probably South Africa is a relatively well-developed or what you refer to as an emerging market, and so it's sort of the next tier of markets. Beyond that, for some investors, the whole continent might seem like a frontier. For other investors, even going into emerging markets is already a frontier. So I think for any investor looking at frontier markets, they should come to their own definition of what frontier markets are. Within FMO, we're quite present in Africa and investing there for decades. And so for us, we probably consider our frontier more the country that you referred to as least developed. But certainly for today's purposes, I think concentrating on the subset of countries that you mentioned is a helpful guideline to frame the discussion.
Very well. Ibrahim, do you have anything to add? I believe Ibrahim hasn't joined us. He will join us momentarily. Why don't we continue with our second topic of discussion, which is what are the common investment themes across African frontier markets? And I think what is important to make relevant is the strong fundamentals in Africa, which we can define perhaps in terms of robust economic growth, expanding urbanization, and increasing disposable income and raising middle classes. Beyond that, Alison, if you could perhaps expand on how do you see and how does FMO sees the common investment themes across Africa, given the fact that you have a regional presence.
Absolutely. Yeah, I think the things that you've mentioned are certainly the key drivers of growth. I think in the past years we saw a certain important impact of rising commodity prices as well, and this sort of global slowdown in that area has impacted the growth profile of some countries in Africa as well, and obviously particularly the ones with a high contribution to GDP of resource exploration and exports. At the same time, I think the growing population, the increasing rate of urbanization, increasing income levels and education levels are all contributing to a source of growth which is less susceptible to global commodity prices. And as well, we mustn't forget many countries are net importers, and particularly of things like fuel, where the decline in the global oil price has had a strong negative effect on a country like Nigeria or Angola, who are substantial oil exporters. For other countries where they are importers or where they've only recently discovered oil and gas reserves and were sort of expecting to become exporters but are still reliant on imports, those countries are positively impacted by decline in the prices for energy. So we certainly see a nuanced impact of the global commodity slowdown across these countries. And the rising consumer class, again, is providing an important driver for investment across the region. So when we think about serving consumers, financial services, telecom services, which has been a substantial contributor to the success of private equity over the past decade. In many countries, we're approaching the 100% penetration of mobile telephony. So you can imagine the numbers of people that are being served now by companies. What's a very scalable industry. Financial services, I think, is set to be the next sort of big consumer play, where, with a relatively limited and scalable infrastructure investment, you can reach a very large number of people. And we're seeing mobile money services, Kenya probably being the most well-known example and the most developed example of having a mobile money industry, which is providing access to financial services for really a very broad range of consumers down to the bottom of the pyramid. And then you can go, into healthcare, into education, and into packaged goods, manufactured goods, retail, and so on.
Very good. Why don't we sort of prioritize all these issues that you have raised, Alison, which I think are very rich, and we can really use them to develop the different themes. Perhaps what I would like to do is to start with the issue of commodity prices, which you raised. We have a drastic drop in commodity prices, which has affected many of the leading countries in Africa, economically, in terms of growth prospects and so forth. On the other hand, there are certain countries, especially the oil-importing countries, which are benefiting from this decline in oil prices. How do you approach, in terms of prioritizing sectors, how important is just the commodity price issue at the moment as either as a motivator or as a deterrent in your global allocation in the region?
Interesting question. I think we as FMO have not been a big investor in resources per se. So if you look over the past few years in Nigeria, for example, there was quite a wave of investment in exploration and production assets as some of the majors were seeking to streamline their portfolios and exit some of the relatively orphan or lower producing assets. FMO has not been sort of actively looking at those kind of investments. We're focused on investing in operating companies, and sort of pure commodity exposure is not something that we've been keen to generate. At the same time, of course, companies are exposed to it to varying degrees, and what you look for, and the same question frankly can be asked about FX exposure. What you look for is companies that have taken a strategic approach to managing that exposure. So you want to ensure that a company is either able to flex its prices to its customers based on the cost of inputs. In the ideal situation, you could adjust your prices upward when your raw material inputs increase faster, than you have to adjust them downwards when those prices go down. But in practice, you look for the models where you have a sort of a margin on your cost inputs that can be maintained in the face of fluctuating raw material prices.
Okay. What about those countries which are benefiting from low prices? Is there any particular area which basically presents opportunities at the moment? I mean, just to give an example, the World Bank recently is mentioning as bright spots Ivory Coast, given the fact that it has a broad-based growth and plenty of rising investment, as well as Kenya and Rwanda. Kenya, you did mention before. But it would be interesting to hear more about the opportunities in these three particular countries where there is a significant benefit from the decrease in commodity prices.
Yeah, and I think what that benefit will mean is on the one hand, certain industrial producers will have lower costs. Again, I think the risk is that those benefits will tend to be reflected in their selling prices as well. So it may be a short-lived benefit, but as well the consumer who needs to buy energy as well as other sort of basic means for existence, it should have a positive impact on expendable income, disposable income for the consumers. Now the three countries that you mentioned, I think each have very attractive growth prospects for different reasons, but one of them that I think is common across them is what you say sort of the peace dividend. Ivory Coast having had quite an extended period of internal strife, if we can call it that, but over the past 5 years or so, sort of settling into a much more stable and peaceful setting. And this has been reflected by the African Development Bank moving its headquarters back to Abidjan after being sort of temporarily housed in Tunisia for about a decade. But as well, a really heightened level of foreign direct investment, both from private equity, but as well from, for example, French retail chains are very actively looking to expand their hotel industry, seeing substantial uptick in investment. I was just actually in Abidjan last week, and as you leave town driving to the north towards Yamoussoukro, which is the political capital, you just see on both sides of the road building projects, new factories going up. And so there's really, I think, a consensus on the part of the investment community that this is both a country with a growth prospect, with a population, and as well as a stable political environment that makes it ripe for investment. Looking at Kenya, Rwanda, I think there are also political stability is a very important component. in both cases. And the other thing I'll highlight about Rwanda, I think they've managed to solve a problem which I think is maybe one of your next topics, but the problem of infrastructure by having a very centralized development program, but to basically manage to develop the road system and logistics in such a way that it has really made it easier for companies to operate there.
Clearly, Ivory Coast and Kenya and Rwanda are taking advantage, as you mentioned, of the opportunities. If we could go back just one last time to the countries that are being affected by the oil and commodity price decline in general, do you see, and I'm referring specifically to countries like Nigeria, Angola, Mozambique as well, which are significantly affected, Gabon as well. Do you see any effort to diversify their economies away from oil and oil-related businesses? And if that's the case, are there any meaningful private equity opportunities down the road?
Mm-hmm. Let me say something about Nigeria, which is of those four countries, the one that I know the best, and as well where FMO has the most exposure in terms of both private equity and overall investment. I think the government there has taken a very explicit stance to want to diversify the economy, and in fact, there are those who say actually the drop in the oil price, although it's very painful, may actually provide a much needed stimulus to do so. I mean, certainly a few industries will benefit from lower input prices, but if you look at the percentage of government income which is coming from the oil industry, it's substantial. I think this poses a risk, certainly in the short term, of being able to sort of fund both the personnel and the investment projects that they have in mind. But on the other hand, I think certainly increasing the income from agriculture and agribusiness is an important objective of Nigerian government, and it certainly gives rise to investment opportunities. Again, it's a tricky place to invest. At the moment, they've taken a bold step, I think, in finally moving away from trying to support the naira at what appeared to be an artificially high level against the dollar. The exchange rate has adjusted substantially earlier this year. There may be an additional correction, but U.S. dollars are still difficult to come by in Nigeria. So any business that's dependent on on imports for raw materials and so on is difficult. But I think looking at sort of local production, particularly using local inputs, can be very attractive. We're looking at the moment to invest together with one of our partners in a business that uses local raw material, will produce a product which should contribute both, it will be an agricultural input, contribute both to sort of the further development of agriculture in Nigeria, as well as create a product which will be competitive on the international market for export. So these are certainly the kind of opportunities that investors should look for in an economy like Nigeria.
Nigeria is always a country that generates a lot of interest, and since we're there now, I wanted to ask you about the new foreign exchange regulations following the free flow decision of the government, and whether or not, as a limited partner, those new foreign exchange regulations are making it easier in terms of facilitating exits or making it more difficult. If you could comment on that, please.
Yeah, I think, frankly, I still wouldn't use the word free float. I think they've loosened the controls on the foreign exchange, but it's still, I think, a somewhat managed exchange rate. Very frankly, I think this is not the optimum time to exit investments in Nigeria. I think we should more consider this to be an investment opportunity, again, with the caveat around there may be a further adjustment in the exchange rate, but I think Nigeria had seen growth rates in the 6 to 8% range, and this year I think the last outlook I saw was about 1.5%. The medium-term drivers are very attractive in Nigeria, but I think this particular moment is more of a buying opportunity than a selling one.
Okay.
We have, by the way, a couple of just I believe last year we have exited an investment in Nigeria with a very good return. So I think that's was co-investment together with Africa Invest and DPI came a bit later into that, an insurance company called Mansard, which we sold to AXA. It's been a very successful investment. I think we're very happy with that, and I would say demonstrates both the attractiveness of the market, the quality of the management team that was running the business, and as well we have been able to take the money out of the country. So just to address the concern that you mentioned there, I think it's definitely a market where attractive investments can be made, have been made, and have been exited successfully as well.
Okay, why don't we move to our next topic, which is how do we support business development platforms in African frontier markets? And again, in terms of definitions, business platforms, what we mean by that is business units which work across countries, leveraging on economies of scale, barriers of entry, efficiency, and consumer common themes and so forth. And it's something which I believe has been a very strong driving force in the past in private equity in other regions. And I think it would be very interesting to know your experience in developing and expanding business prospects in Africa across different sectors. If you could talk a bit about this, Alison, and you know, I'll leave it which sector specifically you would like to have in mind.
Yeah. I think it is actually a question where the sector it very much drives the answer to the question. So, you know, where is it possible to achieve economies of scale across countries, and where are the common themes? One example which comes to mind is a business in East Africa, which was active in pharmaceutical and related healthcare manufacturing and distribution, as well as some consumer goods. And I think East Africa is probably, within Sub-Saharan Africa, the region where the economic integration is most progressed. I've understood it's still not completely seamless, but goods can be transported across national boundaries, and so you can begin to take advantage of some of these economies of scale, both in terms of purchasing when you're distributing internationally imported products, as well as, you know, some things in terms of senior management and operations. We've seen development of groups where, for example, in insurance, in leasing, financial services, where sort of taking a management talent, in many cases from Kenya, if we look at that region, and beginning to move them into adjacent countries where perhaps the markets are somewhat less developed, bringing that management expertise and the experience of an insurance business in Kenya, for example, to Uganda, or even into markets like DRC or South Sudan, has really been an effective way of expanding, of leveraging the experience in one market and blending the sort of international and national teams. One of the important benefits, I think, of this model is actually the development of management talent and the ability to rotate people within a larger organization, which always contributes to more professional, more experienced management teams. I think one of the things that may be underestimated in some cases, the challenges of finding quality management and operating in a multinational environment.
And how do you see the main challenges in terms of moving forward, in terms of regulatory constraints that still need to be taken care of?
I think if I look at this sector, actually the regulators are, I'm thinking specifically of insurance and banking. Regulators, I think, are quite forward-looking. I think there's also a healthy dialogue between the private sector and the regulators, as well as between international investors and regulators. So this is actually an area where I think the market is relatively well served. Certainly, the customs union is an opportunity for further streamlining. If we just zoom out and go back to West Africa, the currency union, I think, in the Francophone countries is also something that has given rise to some efficiencies, both in terms of sort of central banking, the predictability, at least over a period of time, of the exchange rate, and the regulator, which I think is quite active across a number of countries in a consistent and predictable way.
Well, there's always a driving side, and there's always a dragging side as well in terms of economic integration. And the dragging part of it is sometimes the extreme bureaucracy, which instead of driving the process, prevents business opportunities to develop. I mean, I've heard that complaint from some business people in West Africa, but it's I believe just part of the whole process of expanding common and regional markets. What about, can you expand a bit more on the consumer goods sector? If you had any expertise and any recent experience in terms of developing business platforms in the consumer goods?
Well, one of our recent investments, I think about 1.5 to 2 years ago, we co-invested alongside Abraj in a business called Sand Milk, which is making frozen milk, yogurt, and ice cream in West Africa. And this is a company which I think you might think it's quite surprising that you can create a very dense distribution network for a frozen product in West Africa. Ghana is their sort of key market, and they're active in Ivory Coast, Nigeria, and Togo and Benin as well. Cold chain is commonly cited as one of the most difficult problems to solve for the food logistics business in Africa, and yet they've managed to do it and to really make a very large, growing, and profitable business in those markets. What's interesting there, if you look at economies of scale, they're purchasing milk powder on the global market, which is a commodity, and think being able to do that essentially across a number of countries will provide some economies of scale. At the same time, the absolute necessity of local knowledge in one market, in Ivory Coast, there was a ban on plastic sacks, and their packaging had traditionally been in a plastic sack. So they needed to shut down production and sort of retool the product and packaging for one market. So certainly there's still sort of local requirements, and getting the distribution network, the agency or franchise partnerships right, it did require sort of a different approach in each country. But as it turns out, ice cream seems to be quite universal consumer preference. I was there last fall. I tasted the ice cream. It tasted good to the American and to the Dutch tongue as well. So this is, I guess, one thing where there's quite a lot of commonality across countries that can be leveraged.
Very good. Why don't we move on to our next topic, which is support to regional financial institutions. And as a background for this topic, I would just like to remind some statistics in terms of financial penetration of financial services in Africa. Just an example, for instance, in Nigeria, there's only 33% financial penetration between adults against a 50% world average. Incidentally, South Africa has even a higher than world average penetration of about 54%. In terms of credit access, only in Nigeria, only 2% of the adult population has access to credit, against a 9% world average. And another interesting area is SME financing. I understand that in Nigeria, only 2% of working capital is financed with bank loans, again, 70% through internal funds, and 28% of suppliers' credit. All these statistics, I think, make it very obvious that there's a substantial opportunity to do that. And we'd like to understand a bit more, I think, how your business model in support of financial regional institution works, either through direct investments, co-financing opportunities as well.
Yeah, absolutely, absolutely. So maybe just to take one step back, you started out by saying, hopefully everyone knows who FMO is, but I think one of the important features of FMO for the private equity audience is that we're a development finance institution and specifically a development bank. So actually 3/4 of our committed portfolio are in loans, and financial institutions, absolutely the largest sector, represented both in our debt portfolio and in our equity portfolio. So this is a sector which FMO knows very well, has been serving for a very long time, and one where we think both the opportunity from a financial perspective as well as from a development impact perspective is substantial. So supporting the financial sector, how are we approaching that? On the one hand, I think bringing access to banks, simply bringing access to finance has been an important contribution from our side, and with that comes a number of, we hope added value components, such as helping banks to think about their environmental and social responsibilities, and in that sense preserving their reputations as well as contributing to a sustainable financial and business sector in the countries where they operate. We have also every other year a conference called the Future of Finance, where we're bringing participants from across emerging markets together to sort of brainstorm and further the knowledge and the thinking about how finance will look in the future. This is about better serving the communities exactly that you referred to, Oscar. So I think large corporates are quite well served in the countries that we're discussing now, whether by local banks or even by Standard Chartered, Citibank, Deutsche, and so on. But once you get away from the internationally recognized names and the very large companies, we do find that access to financing is still constrained. So helping banks to serve those customers well, helping new institutions to be formed that can serve the smaller companies, and bringing access sort of to retail individuals for financial services. These are all things which we are addressing, and where in many cases we find equity is actually the more relevant instrument to do so. So if I look at, for example, SME finance, I think this is absolutely one of the most difficult segments to serve. By SME, I think all of our definitions vary, but typically you might be looking at financing in the range of, say, $500,000 to a couple of $1 million. Typically these become, put it that way, typically a bank might finance against an asset, but as soon as you look at cash flow-based lending, it becomes difficult. So we've supported both sort of microfinance groups like microcred, which are looking for ways to sort of scale up to reach larger customers, so moving away from the retail and the $5,000 loans into larger ones, as well as supporting more traditional banks to find a way to sort of scale down and reach these customer segments in a way that's profitable for them. So sort of streamlining their credit process. I think big data, or in other words, finding a way to do more automated credit assessments, will also be an important component in making this kind of financing available to a large number of smaller companies.
Correct. And then we have the issue, of course, of interest rates as well, which are very, very prohibitive in the SME microfinance sector.
Absolutely, absolutely. And there, I think that when you talk about regulation, again, this is actually one of the areas where it becomes challenging. In some countries, the regulator has sort of capped the interest rate, very much, I think, in the interests of those companies. But the question then becomes, can you profitably loan money to them, or lend money to them with a capped interest rate? And I think ideally this should give an opportunity for those who can find a low-cost way to process and assess credits, and to those who can build scale. But it certainly presents a challenge in the short term.
For other multilateral development banks, the area of co-financing has always been a mainstream business, and would like also to understand a bit more about how FMO looks at co-financing, investing with other banks on a parallel basis on particular projects.
Yeah, so I think certainly in the lending world, it's very well established. FMO is both a lead and a follower in those settings, depending on sort of who got there first, who knows the sector better, who has the relationship, and so on. So this is absolutely a common practice for FMO as well. Again, particularly in the sectors where we have less experience. On the equity side, I think it's important, again, to differentiate among sectors. In the financial institutions. We have been a direct equity investor and will continue to do so. In the other sectors where we invest, and the sort of named ones would be energy, agribusiness, and infrastructure, manufacturing, and services, which for the careful listener means everything else. We typically approach the market as a fund investor and a co-investor. So we, with a relatively small team of 35 or so investment professionals based in The Hague, don't pretend to cover the whole market, the global market of private equity investment opportunities, but we look for the general partners who do know their local markets well. We look to them for their expertise in sourcing and assessing the quality of the partners with whom they invest, and particularly for value creation. So sort of funds and co-investments absolutely are our core strategy for investing outside of the financial sector.
Very good. I think we are at the end of our topic discussion, and I can see that there are several questions that are coming from the audience. So perhaps we can move on to our next section, which is questions. If I may just start, there's one particular question concerning Zambia, and the question is, how is Zambia perceived as an investment destination? And what are the areas of interest, and what concerns do you have about capital being deployed in Zambia? If you could perhaps explore this a bit further.
Sure, I'm curious to hear your views as well, Oscar. But I think my observation until now is it's relatively underserved by the private equity community. We have in our portfolio few investments there. We have I can think of one investment, which is a regional logistics operator, which is serving Zambia, and there may be sort of one or two agribusiness-related companies which are active there as well. So my sort of feeling, perception about Zambia is it should be attractive because relatively less competition. I guess the concern that goes along with that is more about how should I put that? The investment readiness of companies. There does seem to be a bit of a learning effect in the business community as private equity becomes sort of present and known, that sponsors have a better idea of what to expect from an external shareholder, whether a minority or a majority one. So my concern, I think, would be around the learning curve and the time it might take to sort of educate and negotiate with a sponsor before making an investment.
And if I may add, in addition to what Alison is saying, there have been significant fiscal constraints that the country has gone through, and that has moved most of the rating agencies to downgrade significantly Zambia. As I understand, Moody's, for instance, has a B3 rating, which is below investment grade, well below investment grades, with a negative outlook. So I think that obviously has a big impact in terms of primarily on the debt side. The ability of a country basically to raise money in the capital markets. Having said that, I understand that Zambia has a very strong hydro potential and hydroelectrical potential, and as a matter of fact, I think it does export electricity to neighboring countries, if not on a regular basis, at least on a seasonal basis, and that's one area which obviously could be collateralized eventually for financing opportunities. It has been done in other countries, but again, that has to be looked in the context of the general macroeconomic situation of the country itself. Moving on, the next question is, what emerging markets within Africa are seeing most growth and present the most lucrative opportunities for investors? I think we have covered a good amount of this before. Alison, if you have anything else to add, otherwise we can just move on to the next question.
No, I think that's well covered.
Yeah. Okay. Now the next one is looking forward. Where do you see Africa's frontier markets in 10 years' time?
I guess the question is, where do you see them, or which ones will be the frontier markets in 10 years' time?
Well, I think the formula around that latter. I mean, how do you see the evolution of the arguably the leading countries in Africa in 10 years from now? I mean, how do you see the business developing, particularly as it relates to private equity?
No, it's interesting. Last time I was last week I was in West Africa and was with a colleague from another investment firm who had most recently spent a number of years investing in India. And, his observation was, this place reminds me of the India I grew up in 15, 20 years ago. So I think, that's generally the expectation that I have, that development continues. So that more products and services are available at affordable prices, that the penetration of financial services, the quality of healthcare, the affordability, and the availability of healthcare, health insurance will increase. That you'll see more, and we see that already. One of the important drivers, I think, of the private equity investment universe at the moment is what I heard someone call repats. So if you go to Nigeria now, you will see numerous private equity funds where the principals are Nigerians who have studied abroad, in many cases worked abroad for a number of years, and saw the opportunity sort of at home being too great to resist. And I think we will continue to see that sort of real quality local talent will continue to emerge and also to return to the continent and build this industry to the next level. It'll be some years before it compares to Western Europe or to the US, but I think very much on that pathway. And if you look at India, one of the most competitive private equity markets probably in the world, and to the point where sometimes the valuations are very difficult to explain. But if I had to guess where we're going to be in 10 years' time, that's my expectation.
Well, if you look back 25 to 30 years in Latin America, you would have the same type of observation in terms of how do you see the places, the region developing. There is a specific question concerning FMO business concerning startups. How accessible is FMO to startups? Do you have a team dedicated to empowering the right startups? So startup, this is, I think, the difficult sector for us. It's one where I personally have a passion for, because I did start my career in the high-tech sector, spent some years in Silicon Valley, spent some years in venture capital, and you've probably heard in some of my comments before, I think real scalable business models are certainly the ones that make my heart beat faster. The tricky thing, I think, well, for venture capital in general, it's possible to lose a lot of money, and most people do. So when you think of sort of the upside potential of a single investment or of a venture fund, making a lot of money in venture capital is rare. It's definitely the exception. Investors know that, and therefore it's difficult to find that kind of financing. The venture capital sector, I think, in Africa is emerging. There's, as far as I know, quite a large number of incubators, quite a small number of venture capital funds. So, beyond having a space and a few $1,000s, it's hard to get to the first 100,000 or the first couple of $1 million there. So it's difficult for the industry as a whole, and I think therefore we're investing in private equity funds, but with very, very limited exposure to
venture capital or the kind of funds that would invest in startups. Now, we have invested in a couple of them, primarily not actually technology-oriented, although in the fintech sector, there is one which is in our pipeline, and we have in East Africa invested in a fund called Novastar, which is investing in early-stage companies, mostly actually not technology-driven ones. And we do, from time to time, invest from the government funds which we manage in relatively early-stage companies, typically then in the energy sector, because providing access to energy for sort of rural communities and very low-income consumers is a priority area for us.
And I think your view is common not only among development finance institutions by across different type of institutional investors focused in Africa at the moment. I guess the opportunity on the well-established part of the business is so huge and so untapped that even from a risk point of view, it does make a lot of sense to put priority into that. But of course, the startup is an area that over time should expand. The next question is a broad one, back to Nigeria. The question is, what do you think about private equity opportunities available in Nigeria? We have covered a bit of Nigeria. If you would like to expand a bit more, perhaps.
Sure. And I think Nigeria, at least for a period of time, was the largest economy in Africa and certainly among the most populous. So the things I would look for in Nigeria would be things which have an advantage by a number of consumers or by labor inputs. The government did recently, I think, change its position on textile, so that it may be that there's a growing textile opportunity at a certain point in time. But I think things which will take advantage of the scale of potential consumers, anything which can reach low income and rural consumers, I think would be very interesting. And as well, there's sort of a critical mass, at least a growing critical mass of middle class consumers. So I've seen investments in education, in healthcare there. And again, knowing that it's an oil producer and has a large gas resource, this gives rise to some opportunities. Again, the ones which are more interesting to someone like FMO are the ones which are focused on domestic demand.
Well, one area that I've noticed some general partners' interest in Nigeria is the power sector at the low level of the scale, specifically small power units, which basically help a particular city, a particular region. I don't know if you can comment on that opportunity.
No, absolutely. Very, very good point. I think the privatization of the existing power infrastructure is ongoing and not perfectly straightforward, but certainly opportunities to provide input to the manufacturing base in terms of independent power producers, as well as I believe there should be and will be an opportunity for renewable generation. Solar resource is obviously extensively available, so this is also certainly something of interest. Yeah.
Okay, we have a nice pipeline of questions. So why don't we move on? This is a general subject beyond private equity, but I think it's quite relevant. And the question is private equity the best route to frontier markets, or are there any other effective access strategies? And just to put the question in context, I guess, when we talk about private equity as a source of capital, we are looking at in the context of other sources of capital like public equity, debt, and foreign direct investment. And to the extent that FMO is involved not only in equity but also in debt, perhaps you can expand a bit about how is your internal thinking in terms of your private equity portfolio vis-a-vis the other parts of the business that you're developing in developing countries and in Africa in particular.
Sure, and I think as you said, the question goes a bit broader than private debt and private equity. We have a substantial portfolio in private debt. In fact, this is one that we have now made available to both institutional and retail investors with a couple of partners. So we are actually offering access to our pipeline to third-party investors as well. I sort of take this coming from an asset management perspective and saying, look, I want to gain access to these markets. How should I approach them? The public markets, I think, are still quite thin in the markets that we're discussing, but obviously public equities are always a way to access them. And I think you also mentioned sovereign debt. And by the way, in some cases, companies, some of the larger companies are issuing Euro bonds as well. So I absolutely think there are other ways to access these markets. Some of the benefits which private equity offer are, of course, access to the equity. When public markets are thin, in many cases, this is actually one of the few routes to equity, with the exception, of course, of going there and buying it yourself. But there are certainly other ways. But personally, I'm obviously convinced that private equity is the best way.
Well, I would add that private equities is still very much in its infancy in emerging markets in general, and particularly in Africa. And as such, it is a complementary source of finance, very, very important, very relevant to expand the private sector. But I don't think personally that we should talk much about competition in terms of sources of funds, because at the end of the day, I think the need for capital is much, much stronger than the sources of funding. And I would also like to add that in this interest rate environment where we're seeing negative rates and among industrial countries and many more going in that direction, what I think is going to be inevitable in the next months and years is going to be a much more focused interest on high yield debt coming from emerging markets, because that's probably the only place where, as an asset manager, you can really have a high yield on a fixed income basis. Of course, there's a two side of that story. Historically, that in the past has generated overexposure with all the credit risk problems that we have seen, but at the same time is also a very interesting opportunity. Moving on, the next question is, we could talk a bit about what are the most successful fundraising strategies that GPs can deploy in Africa.
Well, I think the most successful fundraising strategy is to have an attractive fund offering. So when an LP is looking at a fund offering, I think they will typically look at sort of the three core elements, or the legs of the stool, if you will: the strategy, the team, and the track record. And the strategy should be suited to the market, ideally differentiated, although, as you said, these are markets where the capital is so scarce relative to the opportunity, at least sort of in the mid-market and smaller segments, that sort of focusing on the core mid-market segment maybe is attractive in and of itself. But bringing a team to bear on that opportunity, which has relevant experience, of course, in the ideal scenario, sort of a proven track record in the same markets, in the same segment. But we know, as you said, in emerging markets, this is relatively hard to come by. So you will look for private equity experience, operating experience, investment banking experience, or other principal investment experience, which is relevant to the strategy being followed by the fund. And given the definition of frontier markets, we've taken today. I think it's fair to say that Kenya is relatively quite well covered by private equity. Nigeria has a few dedicated country funds, and most of the regional funds are active there as well, but on a relative basis, of course, a much larger economy. And the further you go out from those sort of core markets, the relatively less competitive the markets will be. I guess important to consider when proposing a fund is what is the geographic scope and what is the strategy in terms of sectors. Speaking from FMO's perspective, we have a general preference for regional or sort of Pan-African funds as compared to single country funds. We do make the exception for either the larger economies where it's sufficiently large and diversified to consider a single country fund, or where for some other reason there's a clear logic to focusing on a single country. But generally speaking, we would prefer to have some diversification, both for political, for foreign exchange risks, and so on. And sector-wise, I mean, the standard tends to be manufacturing and services with a focus on consumer-driven, with or without financial sector, with or without a bit of infrastructure or a bit of renewable energy, but making sure that you have a clear understanding of why certain sectors and which ones do you exclude, and again, the relevance of the team and their experience for the chosen strategy. Say key points to consider.
In the analysis of the relevant expertise and track record, how important is the fact of having a team in the field? I was looking at some statistics about the amount of funding raised by domestic managers in Africa, and I was surprised actually. The last numbers I saw for 2014, 50% of money raised by African PE funds went to domestic managers. I'm surprised, but I don't know how to make out of it, whether or not that 50% is big enough or is not big enough. If you have some thoughts on that.
Well, I think it ties into the fundraising strategy, actually. So we should look at that in two ways. On the one hand, I think from the perspective of investing the money, being local is very important. Now, some funds do it by having people from a certain country which live in a different country but travel there. Others do it by speaking the language and traveling there from their headquarters in a different country. And others do it by having nationals of the country in question that are living there. But as I said, for sourcing, for gaining access to investments, and as well for, let's say, the softer side of assessing your business partner, the reputation in the market, I believe local knowledge and in most cases local presence is very important. As well, when you are investing in a company with the ambition to add value to their operations, it's important to spend time with them, and that's easier to do when you're close by. At the same time, we mustn't underestimate the importance of speaking the language of investors. And when it comes to fundraising, as well as maintaining relationships with investors, being close to them can also be important. So, is the 50% enough? I think what probably reflects that it's important to be local, but that investors who are based in, let's say, London or even New York or DC in some cases, by virtue of being close to the institutions, to the LPs who are investing with them, actually do have potentially an advantage in terms of maintaining the contact and the relationship. So I think, another important component of a successful fundraising strategy is to build contact and relationships and rapport with the potential investors over a period of time, and to sort of continue to invest in those relationships. Don't underestimate the importance of actually building a connection with the people who you would like to invest in your fund.
Very good. I believe we are at the end of our session. It's 3 o'clock UK time, and on that note, I would like to thank all the participants. I would like to thank, of course, Alison for covering quite a wide range of subjects. We have some pending questions, which unfortunately we were not able to address. I understand SuperReturn will email those questions, and we can look after them. And Thank you again, and look forward to seeing you in SuperReturn Cape Town at year-end. All the best.
Thank you, Oscar. Goodbye, everyone.
Thank you. Goodbye.